Good morning, afternoon, evening, depending on where you're joining us from today. A big welcome to Swift's LinkedIn Live that tackles the very complex topic of fragmentation. My name is Shriyanka and I head up industry relations at Swift. With me today is John Ferguson, Global Lead, New Globalization at The Economist. And in today's session, we hope to unpack a very significant piece of research by The Economist Impact on financial fragmentation. The research piece that we're going to talk about today is called Growth at a Crossroads, Measuring the Cost of Financial Fragmentation. Swift was drawn to support this piece of research because, as a global critical financial infrastructure that sits at the very heart of the financial ecosystem, moving the world's GDP every 3 days, which then goes on to power economies, cross border trade, supply chains, digital inclusion, innovation, and an entire ecosystem beyond that of Swift. Understanding fragmentation is important. And we had three big questions when we started out. What is the aggregated cost of fragmentation in the short to medium term? Who does fragmentation really impact? And what are the mitigation approaches for the industry to consider as the world fragments? We have the answers to all of these in the report and more. And before we get into the discussion, it's great to see so many of you joining us today on the LinkedIn live stream. Please do feel free to ask us questions in the chat, and we'll answer a few of them. We'll make our best attempt to answer a few of them at the end if we have time. So, John, thank you for joining us today. Um, can you explain a little bit about what is financial fragmentation? Why should we care? And what is driving fragmentation?
Yes, thank you, Shriyanka. It's really great to be with you. We at Economist Impact are really pleased to have the support of Swift to do this research because financial fragmentation is a real and growing risk to the global economy. And as we're going to talk about over the next 20 to 30 minutes, it impacts everyone, every sort of stakeholder, no matter where you are in the world. So to start with, what we think about when we think about financial fragmentation, so we think about cross-border capital flows, cross-border payments, credit, investment, FDI going around the world. So when we think about financial fragmentation, we're thinking about the disruption to those flows, and we'll talk about what drives those disruptive forces in a moment. But it's that disruption that then reduces those cross-border capital flows. So when we use this phrase financial fragmentation, we're talking about a reduction in cross-border capital flows.
Thank you. And I remember when we began this project, our team spent the most time in the methodology behind identifying the scenarios of fragmentation. If you could just deep dive a little bit into the methodology behind the research.
Absolutely. I'll keep this brief, but more than happy to take questions or people to check out the report. We love people reading the report too. But the methodology essentially has sort of three stages. We always, 99% of the time in our research at Economist Impact, do expert interviews. And it's no different on this program. So we reached out to experts around the world from varying levels of economic development in different parts of the world, but also from different institutions. We had experts from academia, from other think tanks, international organizations. So a wide range of experts who helped us with the methodology. And I want to thank them. Maybe some of them are joining here, but definitely a public thanks to all those who always help us on our research programs. And then the second stage was to think about scenarios, which we can talk a bit more about. So we developed these three scenarios. One that sort of talked about keeping financial fragmentation on its current path. One that where it got, we sort of called it an escalation, where it got worse, and one where it was mitigated. And then we used an economic modelling sort of process to understand the real economic impacts of that financial fragmentation. So it was a three-stage process to get us to the point of really trying to understand what is the cost of financial fragmentation.
Thank you. And if you could go on to explain the key findings of this report.
Yeah, so perhaps it's a good time to bring up some of our slides and our charts here. And again, I would encourage everyone, we love everyone reading our work. You'll find more of these charts and images on the hub and in the actual PDF downloadable report as well. So if we can bring up those results, The headline, I would say, the one that we've been sort of talking about and promoting, is the foregone GDP, the foregone economic output of our worst case scenario, that escalation scenario, which is almost 6%, almost 6%, so 5.9%. And the way to think about these results, when we use that methodology I spoke about, we look at 2030, whether it's GDP or jobs, it's sort of foregone. What will not materialize? What will not materialize? So when we talk about almost 6% of GDP not materializing in the worst case scenario, that's what we mean. And similarly on jobs, around 280 million jobs would fail to materialize by 2030 in the worst case scenario. So as we can see here, we have varying levels of scenarios, as we discussed. That worst case is the bottom circle there on the left. It's the escalation scenario. $6.5 trillion of GDP or output that would fail to materialize, and that's a huge figure. And then the employment is on the right hand side there. You can see, even in the mitigation scenario, and that goes for GDP and employment, even in the mitigation scenario, where, again, scenarios are about assumptions. We assume some effort, to slow down financial fragmentation. Even in mitigation in both of these, you still will see foregone GDP, foregone jobs. The new normal situation is what again, scenarios are about assumptions. In the new normal scenario, we assumed sort of a continuation of that current level of fragmentation going further into the future. So mitigation is probably a little bit more optimistic. New normal, you see that sort of fragmentation continuing, and escalation, that's that sort of, in our view, that worst case situation. Almost 6% GDP loss, 280 million jobs that fail to materialize. So that's the sort of real, when economists talk about the real impact, that's the real impact on foregone output and foregone jobs.
And in terms of, you also went about and did a country by country analysis. So any insights from that?
Yeah, absolutely. I won't go through all these countries, but as you can see in the image on the left there, we've used sort of a scale system, a shading system. The headline there is one of the key points. If people don't remember anything else from our discussion, there are no winners. Remember that there are no winners. Financial fragmentation, as I said at the start, hurts everyone, and basically, in our view, can hurt every economy here. There are different shades, different degrees of sort of the GDP impacts that I was just talking about. The darker shade here, China between 4 to 5%, South Africa down there between 3 to 4%, and the US between 2 and 3%. So there are different sort of levels of GDP impacts across the world, but there are no winners. There are no winners. I encourage everyone to go and have a look, but even in this new normal scenario, there are no winners at the country level. And the sort of shading is probably best understood in terms of those economies that are more open, or that receive more of these financial flows, because the assumption is about a reduction. That reduction then has a bigger sort of GDP and jobs impact. So that's where we see that sort of shading there on the left. But just to sort of reiterate the findings on the right, again, this is in our report. You'll see that in that middle escalation there, that 6.5 trillion, really large impact in terms of GDP. But again, even in the others, even in the mitigation, it's a 1.2% sort of foregone GDP by 2030. So no real winners, Shriyanka, at the country level, and those overall global economic impacts, even in the mitigation scenarios, are really quite significant.
Thanks, John. And when you say there are no winners, indeed, at the country level there are no winners. There are no winners when you look at it. The businesses, everybody gets impacted, including people, right? We're talking about jobs here. So just to reconfirm, these are jobs that will not get created, right?
Yes, yeah, that's right. That's right. So when we do our scenario work, and we love doing scenario work because it helps us all think about potential different futures, we do have a baseline from our colleagues at the EIU. So at Economist Impact, we do the research with support of great partners like Swift, but we also lean on our internal colleagues at the EIU, the Economist Intelligence Unit. So we start by saying, where does the EIU think global GDP will be in 2030, and where will global jobs be in 2030? And then these scenarios are about understanding those potential futures. So jobs are still being created in these potential futures, but it's about what jobs will fail to be created, what jobs will fail, how many jobs will fail to materialize. And I also think about that in terms of GDP. So GDP is sort of the economic output of each country. Global GDP is the economic output of the entire world. How much economic output fails to materialize under these different scenarios? So yes, there's still GDP. Yes, there are still jobs being created, but the best way to think about this scenario work is the jobs or output that fail to materialize.
Absolutely. So we, in a way, fragmentation slows down growth, and everybody gets impacted. I understand that. So in terms of the research, you also go on not just to unpack and look at scenarios and put a cost and outline that nobody really wins, but you also have towards the end of the section, uh, you're actually outlining the possible steps that public sector and the private sector stakeholders could take to mitigate the impact. If you could just talk us through a little bit of what are those steps that we can use to mitigate a little bit of still moving the cart when there is fragmentation in the backdrop.
Yeah, absolutely. And if I could just take one step back, Shriyanka, I just want to set a bit of a scene, because when we talk about steps people can take, one of the points we make in the paper, and I'll make shortly, is that all stakeholders need to take steps. And I'm sure you have some of your own views as well from Swift's perspective too. But in the report, we talk about multiple stakeholders having a role. But just to take one quick step back, the story I want to tell, and we do tell in the report, is that when people think about fragmentation, and we want everyone to read the paper and go to the hub, this is not an overnight thing. This is not a one person thing. This is not a one country, one factor, one driver thing. When we sat back and looked at this has been slowly but surely growing, at least since the global financial crisis of 2008, 2009. And everyone in this sector and all the people joining us will understand how significant that was. We saw cross-border flows, FDI, all falling after that huge economic shock. And they basically failed to recover, whichever sort of cross-border flow you look at. And then over time, we also had fintech, and fintech brings a lot of positive benefits. We talk about Kenya's M-Pesa and a great example, but also the more of these little systems get created around the world, it can lead to fragmentation if you don't focus on interoperability and connectedness amongst these great systems. And then finally, there was sort of sanctions and trade wars, and you mentioned the impact on supply chains earlier, Shriyanka. So all these things have been coming together over a long period of time. So it's not just one driver, not one person, not one country, not one factor. So that's the background context we wanted people to understand in the paper. So that sort of leads us on to then stakeholders. If there was a magic bullet, if there was a silver bullet, whatever that expression is, it'd be great if we could just say one thing, one organization, one international organization do one thing. That would be wonderful, but it's not the case. We essentially need all these stakeholders playing a role. So those international organizations, which are really important in the global system, they can be encouraging sort of openness and interoperability and collaboration amongst these systems. We talk about technology providers helping banks and financial institutions create sort of integrated solutions for customers that helps sort of encourage that interoperability as well. We do talk about regulation and policymakers incentivizing or sort of regulating interoperability to help people again, and it's all about sort of connectedness, bringing people together, bringing these systems together, and sort of pushing back a little bit against fragmentation. But we also talk about financial institutions themselves. Shocks happen. Shocks, by definition, we don't know when they're coming. So we talk about capital buffers, liquidity buffers, risk management for these financial institutions. So when an unfortunate shock does happen in the future, that sort of impact on fragmentation that we saw in 2008, 2009 doesn't happen again. So financial institutions have a role, technology providers have a role, regulators have an important role, but it's all about interoperability, harmonized regulations as much as possible, and just connectedness of these systems and platforms as much as humanly possible.
Thank you so much. Yes, I think we're all in this together. And the research establishes and reaffirms, right, that there is a link towards efficient flow of capital and goods around the world that drives economic growth. And SWIFT has been pretty much this invisible backbone towards global financial integration over the last 51 years. And SWIFT is committed to interoperability. And you spoke of newer networks and the pace of technology innovation and the role for these different actors, in the industry to come together and ensure that there is interoperability. So let me talk a little bit probably about what Swift does in terms of ensuring that there are common industry goals and we put our right expertise and focus when it comes to our strategy and the community assets that we build out. So later in this year, towards November, the Swift community and the wider financial services industry will embrace open data standards of ISO 20022. Over 11,500 institutions on the network will adopt that. But in parallel, there are 40 other RTGSs, high value payment systems, that are embracing ISO 20022, an open data standard, a rich data standard. And this is a step to speak the same language, a foundational step to interoperability of the financial ecosystem. And then there is a lot of coordinated industry effort towards the G20 cross border enhancement roadmap. It's a multi year roadmap, but our strategy is very closely aligned to this roadmap, and we're trying to focus into the next year where really are the frictions, right? So there are targets and KPIs around speed, and there are speed bumps, and those speed bumps are of different natures. It could lie, be very corridor specific with and with banks not being able to automate. It could be with markets and opening hours of market infrastructures. It could be around FX and capital controls. And so there is a huge amount of work that needs to be done, not only in terms of uh, mobilizing the resources effectively across the private sector, but also in terms of regulation and policy making to accelerate some of these goals. And it's happening. But the point is that all of this is in the backdrop of fragmentation, right? And it could derail some of these efforts overnight and decelerate the speed at which the industry needs to move. And just in terms of even innovation being that invisible plumbing, not just of capital flow, but also as an inclusive network, uh, which is stood for years of operational resilience and standardizing information exchange and advocating market best practices. There is also a responsibility that we have towards responsible innovation and scaling new technologies, whether we look at AI, whether we look at blockchain. And a lot of our exploration towards moving newer asset classes, digitally tokenized asset classes over our network, is moving from exploratory to a pilot phase. We are using AI to detect anomalies on the network. Again, we've moved to a pilot stage this year. These are significant steps, and we're making sure that we are there to fight the common enemy of fraud and nobody gets left behind. So that's the underlying principle with which our strategy and our assets are evolving. And we've got a very strong support from the Swift community as well. But that's a little bit about the principles which underlie the way Swift operates and that critical foundational layer of interoperability that we are in the financial architecture. Now I'll stop here a little bit and probably the best time to see if we have a few questions from the audience. Just beginning to come in. Thank you for that. So we have a question over here, John, which talks about, well, mitigating strategies. Are there enough, are the mitigating strategies outlined sufficient to reverse financial fragmentation? Or do we have to accept some of the fragmentation, and is it unavoidable?
Oh, listen, it's a great question. I'd like to think we don't have to accept fragmentation, but I'm also not naive enough to think that we can turn this around in a day. Um, I work for the Economist Group. I work for Economist Impact. The Economist Group stands for sort of openness and connectedness and basically everything opposite to fragmentation. It's a lofty goal, And we all understand how complicated today's global economy is. I mean, we look at it in other research programs. The Economist newspaper writes about it every week, every day. We get all that. So I'm not naive, but I'd like to think we don't have to accept it, because I think what this modelling exercise and our sort of research exercise has shown is that there are no winners, and even some fragmentation is harmful. Again, we believe in openness, we believe in connectedness, and interoperability, and bringing these benefits to people around the world. So I'm not naive, but I'd like to think that we don't have to accept it. We did go through all the stakeholders involved. This is a hugely complex system, and some of you are much deeper in the weeds of this system than I am, right? This is a very global, big picture study that we just conducted. You all know how complex the system is and all the stakeholders involved. But I just think, if everyone can play their role, and that's partly why we wanted to, work with Swift and have the support of Swift on this program, to lift the conversation, to have this conversation, to ask everyone to think about what their role is. So it might be idealistic and maybe it's a lofty goal and it won't happen over one day, but I'd like to think that we can turn this around. It's going to take a lot of collaboration and cooperation, and also just a lot of communication with each other in the system, because everyone's going to play a role.
Thanks, John. And the report talks about technical decoupling. I think from Swift's perspective, we see that happen. And the way the global economic landscape operates is through interconnected networks, and Swift plays a role in facilitating that integration. Now, with the rapid pace of innovation, the need for sovereignty, fragmentation is inevitable, from the Swift lens as well. And today we operate domestic market infrastructures which are specific to countries. Tomorrow there are going to be a new generation of networks, whether we're talking about pan regional real time payment networks, whether we're talking about token economies. All of this is inevitable. But what remains, I think, the underlying principle, which allows us to operate even in a fragmented backdrop and stand for interoperability, is that we are heading into the future with the approach of being a model agnostic platform, a currency agnostic platform, a value agnostic platform, and most importantly, we're advocating for interoperability by design, which means to keep the flow of capital moving, we need to speak the same language. Um, and as the different actors operate across these different fragmented networks and digital islands, there will be some trade-offs and some risks introduced as well. A new set of capital structure, a new liquidity challenge, all of this is inevitable. But at the end of the day, when you look at geopolitics and geoeconomics, they follow 3 to 5 year cycles. But when you look at market infrastructures, their vision, the investment, and the roadmap, they follow 10 to 30 year cycles. So at every decision maker, policy maker table today, interoperability by design is supremely important, and something that could um, counterbalance the pace at which we're heading into fragmentation. So I mean, that is just what I had to add. But in terms of anything else, John, that you would like to add as you go back and reflect on the piece of research, and any kind of advice that you would put out there for your readers?
Yeah, I think I would reiterate the point that this has been a long time coming.
Hmm.
It's not just new. It's not just a couple of people around the world driving this. It's been coming for a long time. It's been building for a long time, and that's important to understand, because when we try to turn this around, and maybe we don't want to accept any fragmentation, it's going to take a lot of stakeholders, a lot of effort, a lot of conversations, a lot of harmonized regulations. That's a lot of people coming together to try and turn this around. So I really wanted to make sure, and that's why I tried to sort of articulate that in our discussion, that this is slowly but surely growing in the global economy, but we don't have to accept it. I mean, the world is poorer, a fragmented world. I mean, we can look at other types of fragmentation. The world is poorer from fragmentation. Um, so if we can accept that, then hopefully we can do something about it.
Well, for all my readers, I'd like to quickly bring up the QR code, because this is a report everybody ought to read. Um, and as I reflect about not just the report, but all of the stuff that you've said today, John. I think it's important that I wrap this up in the last couple of minutes in terms of the top takeaways from today's discussion. I think your last statement, everybody is going to be poorer, the world is going to be poorer, it sticks with me. In terms of financial fragmentation, what is it? It's a reduction of international financial integration, disruption of cross border payments, and that adds friction and derails a lot of the work that's done over the last, you know, 50 years of global integration. It hinders economic growth at scale. Global GDP losses, to the tune of 6.5 trillion could be wiped off the economy until 2030, and over 280 million jobs will not be created, which means we are in a way depriving those children that are studying in universities and will graduate the new workforce of 280 million jobs. There is risk and uncertainty for those founders who are dreaming of launching fintechs and the whole startup ecosystem. To operate against this whole backdrop of risk and uncertainty is a cost in itself. There are no winners to this fragmentation, no country, no specific business, everybody loses. And interoperability in the backdrop of fragmentation is not easy. Looking at it from a Swift lens, no one country can do it alone, no one institution can do it alone. So we need dialogue, we need cooperation to build a secure, trusted, efficient, and interconnected financial system, ecosystem, if I may call it. And just to wrap up, SWIFT remains committed to that mission of interoperability and to give the future an interconnected global economy that benefits all countries, people, businesses. We stand for that. Thank you very much today, John, for joining us on this LinkedIn Live. And it's been a great pleasure to work with you and your team and The Economist on this project. So thank you on behalf of SWIFT.
Thank you so much, Shriyanka. At Economist Impact, we were really happy to have your support, and I hope everyone can head to the hub, download the report, and just keep the conversation going. We do believe fragmentation leaves everyone poorer, so we want to make sure the conversation continues.
Thank you very much.